There is a ghost in the machine of modern capitalism. It is a force so powerful it can compel the most brilliant of executives, the most lauded of chief executive officers, to commit acts of breathtaking financial self-sabotage. It is a pressure so pervasive that it turns boardrooms of esteemed professionals into echo chambers of catastrophic consensus. This force has a name, given to it by the one man who has built an empire larger than many nations by simply betting against it. Warren Buffett calls it the institutional imperative. It is the invisible script that dictates that the herd must be followed, even when the herd is stampeding towards a cliff. It is the tendency of organizations to mindlessly imitate the behavior of their peers, to expand for the sake of expansion, to resist necessary change, and to engage in a ritual of corporate activity that has all the appearance of strategic thought, but is utterly devoid of its substance. Most investors, even those who consider themselves sophisticated, operate under a dangerously flawed assumption that large, public companies make rational decisions. They read the press releases, they listen to the earnings calls, they analyze the polished presentations, and they believe the story. They believe that the chief executive officer, with his MBA from a prestigious institution and his multi-million-dollar compensation package, is a hyper-rational captain steering the corporate ship with analytical precision. This belief is the single most expensive mistake an investor can make, because the truth is far more chaotic, far more human, and far more predictable for those who know what to look for. The institutional imperative is not an occasional error. It is a fundamental law of organizational physics. It explains why a company with a dominant, high-return business will dilute its success by acquiring a mediocre, low-return business at an exorbitant price. It explains why a company will cling to a dying technology, pouring billions into its defense, while a more agile competitor rewrites the rules of the game. It explains why bureaucracies swell, why costs creep ever upward, and why the pursuit of size so often trumps the pursuit of per-share value. This is not a lecture on corporate governance. This is an operational manual for a weapon of perception. It is a framework for looking at the very same data as everyone else and seeing a completely different reality. It is about understanding that the biggest follies in the business world are not random. They are systemic. They are baked into the culture, the incentives, and the very psychology of a large organization. And because they are systemic, they are predictable. And what is predictable is exploitable. This is the ultimate form of contrarian investing. It is not simply about buying what is out of favor. It is about understanding the deep, structural reasons why it is out of favor. It is about identifying the companies that have become prisoners of their own success, shackled by the institutional imperative, and betting against their inertia. Or, even more powerfully, it is about finding the lean, hungry competitors who are free from these constraints and are positioned to devour the complacent giants. We are about to deconstruct this powerful mental model, this secret of true value investing, into its core components. We will not speak in hypotheticals. We will journey through the real-world battles, the billion-dollar blunders, and the masterstrokes of insight that define Warren Buffett's career. We will dissect the psychological biases that fuel this corporate madness, and we will build step by step a practical blueprint you can use to apply this thinking to your own investment analysis, your own career, your own executive decision-making. This is your invitation to stop looking at the stock market as a game of numbers on a screen and start seeing it for what it is, a grand arena of human folly, where fortunes are made by those who can calmly identify and profit from the predictable stupidity of the crowd. This is how you learn to bet against the MBA. This is how you profit from the institutional imperative. Our first foray into this hidden world of corporate irrationality begins with the most dramatic, the most celebrated, and often the most value-destructive ritual in the corporate playbook: the grand spectacle of mergers and acquisitions. The institutional imperative finds its most potent expression in the corporate acquisition. The dynamic is primal. A rival company announces a major deal. The CEO of our company reads about it in the Wall Street Journal. The board members start to murmur. Analysts begin to ask questions on the quarterly call. What is your M&A strategy? The pressure builds. A deep instinctual fear takes hold. The fear of being left behind, of appearing stagnant while peers are making bold moves. The desire to do something becomes overwhelming. And so, the hunt begins. Investment bankers, who are paid handsomely for transactions, not for thoughtful inaction, descend with glossy pitch books, whispering sweet nothings about synergies, scale, and strategic fit. The CEO, whose compensation and prestige are often tied more to the size of the empire he commands than to its profitability, becomes intoxicated by the thrill of the chase. The deal becomes an end in itself, and this is where the seeds of shareholder destruction are sown. To understand this in its most visceral form, we must travel back in time, not to witness one of Buffett's celebrated triumphs, but to dissect his single greatest mistake. A mistake he himself called his nemesis, a mistake that cost his shareholders not millions, but billions. A mistake born directly from the very forces he so often warns against. We're talking about the acquisition of Dexter Shoe Company. In 1993, Berkshire Hathaway was already a corporate titan, and Warren Buffett was a living legend. His track record was pristine. He had built an empire by buying wonderful businesses at fair prices. Dexter Shoe, based in Maine, seemed to fit the bill perfectly. It was a durable American brand. It had a long history of profitability. It was run by a family he admired. And, critically, it had what Buffett believed to be a durable competitive advantage, a business moat. He was so confident, in fact, that he decided to do something he rarely does. He paid for the acquisition not with cash, but with Berkshire Hathaway stock. The price was $433 million. Paid for with 25,203 shares of Berkshire A stock. At the time, this seemed like a stroke of genius. Buffett was using his own highly valued currency, his company's stock, to buy a solid cash-generating asset. He wrote in his annual letter that Dexter was a business he and his partner Charlie Munger could understand. He praised its management and its position in the marketplace. He had done the deal. The imperative to act, to add another jewel to the Berkshire crown, had been satisfied. But a subtle, deadly force was already at work, a force that Buffett, in his enthusiasm for the deal, had underestimated. That force was global competition. The moat he thought was a wide, unbreachable castle wall was, in reality, a shrinking stream. Low-cost shoe manufacturers from overseas were beginning to flood the market. Dexter's competitive advantage was not, as he had believed, rooted in its brand or its manufacturing process. It was rooted in a temporary cost advantage that was evaporating before his eyes. The business he had just bought, the one he was so proud of, began to bleed. Its profitability collapsed. The durable competitive advantage was a mirage. Within a few years, the entire business was worthless. But the true cost, the number that haunted Buffett, was not the $433 million price tag. The true cost was what he had given up. Those 25,000 shares of Berkshire stock that he traded for a dying shoe company would, over the next 2 decades, go on to be worth billions upon billions of dollars. As of recent valuations, that stake would be worth well over $12 billion. He hadn't just bought a bad business. He had traded a portion of one of the greatest value creation engines in history for a melting ice cube. He had committed the cardinal sin of capital allocation. He had traded something of immense and growing value for something of diminishing value. Why? The institutional imperative. Even the master himself was not immune. The desire for a deal, the excitement of adding a new company to the fold, the social proof of buying a well-known brand praised by others, these forces created a subtle distortion field. It clouded his judgment on the one thing that mattered most, the durability of the company's competitive advantage. This story is not just a historical footnote, it is the foundational lesson. It demonstrates that the M&A arena is where the institutional imperative runs wild. CEOs, driven by ego and a fear of falling behind, chase deals. They overpay for mediocre assets, using their own shareholders, money, or even worse, their own valuable stock, as ammunition. And they do it because everyone else is doing it. They do it because Wall Street rewards activity. They do it because the machine demands to be fed. The Dexter shoe catastrophe serves as a permanent, multi-billion-dollar monument to this truth. It is the ultimate proof that when the mania for a deal takes hold, even the most rational of minds can be seduced into a value-destroying folly. It teaches us that the first question in any M&A analysis should not be what are the synergies, but rather, what irrational institutional force is driving this decision? The Dexter shoe saga is a financial tragedy, but its roots are not in spreadsheets or valuation models. They are buried deep within the primal operating system of the human brain. The institutional imperative, especially in the context of mergers and acquisitions, is powered by a potent cocktail of cognitive biases, the mental shortcuts and irrational glitches in our thinking that behavioral finance has spent decades identifying. To profit from this folly, you must first become a student of its psychological architecture. The most dominant force at play is what psychologists call social proof, or, more commonly, herd behavior. Human beings are social creatures. For millennia, our survival depended on our ability to stick with the tribe. The person who saw the rest of the tribe running and decided to stop and analyze the situation for himself was likely the first one to be eaten by the saber-toothed tiger. We are hardwired to believe that if everyone else is doing something, it must be the right thing to do. In the corporate world, the tribe is the peer group of companies in an industry. When a major competitor like Cisco in the late 90s starts acquiring dozens of smaller tech companies, the CEOs of Juniper and Nortel don't see a potentially reckless strategy. They see the tribe running. The signal is clear: we must acquire to survive. The internal analysis becomes secondary to the external pressure to conform. This creates what is known as an informational cascade. The first company makes a deal. The second company, now feeling the pressure, looks at the first company's action as a piece of information in itself, perhaps overweighting it. By the time the third and fourth companies join in, the behavior is no longer based on any independent analysis of the underlying business reality, but is purely a reaction to the actions of others. The herd is in full stampede. Closely related is the fear of missing out, or FOMO. This isn't just a phenomenon for social media users, it's a powerful driver in the boardroom. A CEO sees a rival getting laudatory headlines for a transformative acquisition. They see the short-term bump in their competitor's stock price. They feel the sting of inaction, the pain of potentially missing out on a game-changing opportunity. Even a phantom one often feels more acute and immediate than the distant, abstract risk of overpaying or making a strategic error. This emotional response short-circuits the rational, long-term capital allocation process. The imperative shifts from "let's make a good decision" to "let's make a decision now." Then there is the overconfidence bias, particularly the strain that infects successful leaders. A CEO who has overseen a period of growth and success naturally starts to believe in their own superior judgment. They attribute their success purely to skill, underestimating the role of luck or favorable market conditions. This leads to a dangerous belief that we can fix this company, or we are the ones who can unlock the hidden value. They look at a struggling acquisition target and see not a flawed business, but a testament to their future managerial brilliance. This is particularly dangerous when combined with the synergy myth. Synergy is the idea that 1 + 1 will equal 3, that by combining two companies you will unlock magical cost savings and revenue opportunities. While true synergies do exist, they are rare and almost always overestimated during the deal fever stage. The overconfident CEO, backed by equally overconfident bankers who are paid to create these projections, latches onto these synergy estimates as fact. They use these inflated numbers to justify paying a massive premium over the target company's current market value, a premium from which the acquiring company's shareholders almost never recover. This entire psychological drama is amplified by the agency problem. In theory, the CEO and the board work for the shareholders. In practice, their incentives are often wildly misaligned. A CEO's pay, power, and prestige are often directly correlated with the size of the company they run. A $20 billion company CEO is more famous and typically better paid than a $10 billion company CEO, even if the latter company is more profitable and generates better returns on capital. An acquisition is the fastest way to double the size of your empire. Therefore, the CEO has a built-in, personal incentive to do deals, even if those deals destroy per-share value for the actual owners of the business. The shareholders are playing a game of maximizing return on investment. The CEO is often playing a game of maximizing personal power and compensation. The institutional imperative provides the perfect psychological cover for this divergence of interests. The CEO can justify a bad deal by saying, "We had to remain competitive. Our peers were all doing it," or "We are building a platform for future growth." These are the socially acceptable narratives that mask the underlying, often ego-driven, motivations. By understanding this psychological landscape, the savvy investor gains an immense advantage. While others are reading the press release about strategic rationale, you are diagnosing the cognitive biases at play. You are asking, is this a case of herd behavior? Is the CEO overconfident? Are the synergy estimates realistic? Or are they a fantasy designed to justify a price born of FOMO? You are moving beyond the company's story and analyzing the psychology of its decision-makers. This is the foundation of a true, behavioral approach to investment analysis. So how do we translate this understanding of corporate psychology into a practical, repeatable process? How do we build a blueprint for identifying and profiting from M&A-driven folly? It requires becoming a forensic accountant of corporate strategy, looking for the subtle clues that betray the presence of the institutional imperative. Here is a step-by-step mental model for your own M&A analysis. Step 1. Analyze the financing. This is perhaps the most critical and most overlooked clue. How is the acquirer paying for the deal? There are two primary ways, with cash or with stock. When a company pays with cash, it's a painful, tangible act. Cash spent on an acquisition is cash that cannot be used for dividends, share buybacks, or internal investment. Management tends to be more disciplined when spending actual money from the company's bank account. But when a company pays with its own stock, a dangerous psychological shift occurs. To a CEO in the grip of deal fever, the company's stock doesn't feel like real money. It feels like a magical, ever-expanding currency. This was the heart of Buffett's Dexter shoe mistake. He used his own fantastically valuable Berkshire stock. He would have been far more circumspect if he had to write a check for $433 million in cash. So your first filter is this. If a company is making a major acquisition using its own stock, especially when that stock seems fairly or even overvalued, a giant red flag should go up. It's often a sign that management believes their own shares are the most expensive thing they can find, so they might as well use them to buy something, anything, else. It's an act of implicit capital destruction. Step 2. Deconstruct the premium. No one sells their company for its current stock price. The acquirer must always pay a, quote, control premium to entice shareholders to sell. The key is to analyze the size of this premium. A modest premium of 15 to 20% might be justifiable. But when you see premiums of 40, 50, or even 100%, you are witnessing an act of desperation, not strategy. To justify such a premium, the acquirer would need to generate truly heroic synergies, which, as we know, rarely materialize. A massive premium is the clearest numerical evidence of FOMO and overconfidence. It tells you that the buyer's emotional desire to win the deal has completely overwhelmed their financial discipline. You should calculate the premium yourself. Take the offer price per share, subtract the target stock price from a month before the deal rumors started, and divide by that pre-rumor stock price. That percentage is the premium. The higher it is, the more likely it is that value is being transferred from the acquirer's shareholders to the target's shareholders. Step 3. Scrutinize the strategic rationale. Read the press release and the investor presentation announcing the deal. Your goal is to translate the corporate jargon into plain English. Be deeply skeptical of vague, buzzword-heavy justifications. Phrases like transformational acquisition, creating a global leader, synergistic combination, or accelerating our platform strategy are often meaningless platitudes used to dress up a deal that lacks a compelling business logic. What you are looking for is a simple, clear explanation of how the deal will improve the company's competitive advantage. Will it give them a new technology they couldn't build themselves? Will it provide access to a distribution channel that is truly exclusive? Will it allow them to materially lower their costs in a way that is sustainable? If the rationale boils down to, "we will get bigger," or "our competitor bought a similar company," you are almost certainly looking at the institutional imperative in action. Step 4. Investigate the integrator's track record. Some companies are brilliant acquirers. They have a long history of buying smaller companies, integrating them smoothly, and creating value. Danaher and Constellation Software are classic examples. They have a system, a culture, and a discipline around M&A. Most companies, however, do not. They are occasional acquirers who lurch from one big bang deal to another. Before you ever get excited about a deal, go back and look at the acquirer's last 3 to 5 major acquisitions. What happened to them? Did the promised synergies ever show up in the financial statements? Is the company's return on invested capital higher or lower today than it was before that acquisition spree? History is the best guide. A company that has a history of overpaying and under-delivering on acquisitions is highly likely to do it again. The institutional habit is too strong to break. By following this 4-step process, analyzing the financing, deconstructing the premium, scrutinizing the rationale, and investigating the track record, you build a powerful defense against the hype and misinformation that surrounds corporate M&A. You move from being a passive consumer of the company's narrative to an active, critical analyst of its behavior. You will begin to see the deals not as bold strategic moves, but as the predictable outcomes of flawed human psychology playing out on a multi-billion-dollar stage. The path illuminated by this blueprint, one of skepticism, deep analysis, and behavioral insight, is a lonely one. It is the path of the contrarian investor. The vast majority of market participants, the 99%, take the opposite approach. They are not the exploiters of the institutional imperative. They are its victims. Their journey through the M&A landscape is a masterclass in wealth destruction, and understanding their mistakes is just as important as understanding Buffett's successes. Let's trace the path of the typical uninformed investor. The news breaks: Megacorp to acquire Innovate Inc. in a $20 billion blockbuster deal. The headlines are splashy. The financial news networks bring on experts who breathlessly praise the bold vision of the Megacorp CEO. The stock of the target company, Innovate Inc., soars by 40% overnight, confirming for everyone that this is a valuable, desirable asset. The investor, caught up in the excitement, sees the stock of the acquiring company, Megacorp, dip slightly on the news. They think, this is a great opportunity to buy into a bigger, stronger company at a discount. They're creating an industry leader. They place their buy order for Megacorp, feeling clever for getting in on the action. This first step is a catastrophic error rooted in a complete misunderstanding of the M&A value transfer. The immediate beneficiaries of an acquisition are almost always the shareholders of the company being bought, the sellers. They are the ones receiving the massive premium. The acquiring company's shareholders are the ones who have to pay for it. The initial dip in Megacorp's stock is often the market's correct initial judgment that the company has just overpaid for an asset. The 99% investor misinterprets this signal of value destruction as a buying opportunity. Next, Our investor listens to the conference call. The megacorp's CEO speaks with conviction about the incredible synergies and the accretive nature of the deal. He uses sophisticated-sounding financial terms and presents slides filled with impressive-looking charts showing a glorious combined future. The investor, lacking the deep financial modeling skills to question the assumptions behind these charts, falls prey to authority bias. This well-dressed, confident CEO must know what he's doing. The slick presentation from the Wall Street investment bank must be accurate. They take the narrative at face value, never pausing to ask the hard questions. What is the real tangible basis for these synergy numbers? What if revenue growth slows? What if the cultures of the two companies clash? As the months go by, the integration process begins, and it is almost always harder, slower, and more expensive than promised. Key employees from the acquired company, now rich from the buyout, begin to leave. The promised cross-selling opportunities fail to materialize because the sales teams are busy fighting over territory. The costs to merge the two different IT systems spiral out of control. These problems are reported deep in the footnotes of the quarterly earnings reports, if they are mentioned at all. The CEO on the earnings calls speaks of transitional headwinds and integration challenges, but assures investors that the long-term strategic vision is fully on track. Our investor, now a victim of commitment and consistency bias, holds on. They have made their decision, they have publicly or privately committed to the idea that this was a good investment, and they are now psychologically resistant to information that contradicts that belief. To sell now would be to admit they made a mistake, so they hold, telling themselves that these are just short-term problems. Finally, a year or two after the deal closes, the reckoning comes. The company misses its earnings forecast. It announces a massive goodwill impairment charge. This is the accounting world's way of finally admitting what was obvious from day one. We wildly overpaid for the asset we bought. The stock of Megacorp plunges. Our investor, who bought in the initial excitement, has now seen a huge portion of their capital evaporate. They sell in a panic, blaming the market or bad luck, never realizing that the disaster was entirely predictable from the very beginning. They were simply following the path of the 99%, a path paved with media hype, misleading corporate narratives, and a susceptibility to the most basic of cognitive errors. They celebrated the deal instead of scrutinizing it. They trusted the storytellers instead of the numbers. They were, in the end, just another casualty of the institutional imperative. The consequences of a poorly conceived acquisition are not just theoretical or psychological. They leave deep and permanent scars on a company's financial statements. A skilled investor knows how to read these statements like a detective investigating a crime scene, finding the clues of value destruction that others miss. The connection between the institutional imperative and the numbers on a balance sheet is direct, quantifiable, and devastating. Let's start with the balance sheet itself. When Megacorp buys Innovate Inc. for $20 billion, and Innovate Inc. has tangible assets like factories and cash worth only, say, $5 billion, where does the other $15 billion go? It is recorded on Megacorp's balance sheet as an asset called goodwill. Goodwill is an intangible asset. It represents the premium paid above the fair market value of the tangible assets. It is, in essence, the capitalized value of all those hoped-for synergies and future growth prospects. In a healthy acquisition, goodwill represents the price paid for a truly fantastic business with a powerful brand and pricing power. But in an acquisition driven by the institutional imperative, goodwill is nothing more than a monument to a CEO's ego. It is the ghost of money spent, a placeholder for value that was promised but will likely never materialize. Your job as an analyst is to be relentlessly skeptical of goodwill. A company with a huge and growing goodwill balance relative to its total assets is a company that has been on an acquisition binge. This is a potential red flag. The real danger comes later with the goodwill impairment we mentioned. Accounting rules require that a company periodically test its goodwill to see if it's still worth what they paid for it. If the acquired business underperforms and it becomes clear that the future cash flows will never be enough to justify the purchase price, the company is forced to write down the goodwill. This results in a massive one-time charge against earnings. The company will try to frame this as a, quote, non-cash charge and tell you to ignore it. You should do the opposite. A goodwill impairment is the company's formal admission of a massive capital allocation error. It is a confession, written in the language of accounting, that they destroyed shareholder money. Next, look at the debt on the balance sheet and the interest expense on the income statement. Many value-destroying acquisitions are funded with massive amounts of debt. A company that previously had a clean balance sheet might suddenly find itself with billions in new loans. This dramatically increases the risk profile of the business. The interest payments on this debt are a fixed cost that must be paid every single quarter, regardless of how the business is performing. This reduces financial flexibility and makes the company vulnerable in an economic downturn. A key part of your financial modeling should be to stress test the company's ability to cover its new, higher interest payments. Finally, and most critically, you must focus on the true metric of value creation. Return on invested capital, or ROIC. ROIC measures how much profit a company generates for every dollar of capital that has been invested in the business. A great business can consistently generate high returns on capital, say 15% or more. When a company makes a large acquisition, especially an overpriced one, it dramatically increases the denominator of this equation, the invested capital. It has poured billions of new capital into the enterprise. However, the numerator, the net operating profit after tax, often fails to increase proportionally because the promised synergies don't appear. The mathematical result is a sharp decline in ROIC. This is the smoking gun. It is the clearest possible evidence that management has taken a high-return business and diluted it by purchasing a lower-return business. While other investors are distracted by metrics like adjusted earnings per share, which executives can manipulate, ROIC tells the cold, hard truth about whether management is creating or destroying value. Your task, as a serious investor, is to track a company's ROIC over time. If you see a steady, high ROIC suddenly plummet and stay low after a major acquisition, you have found a company in the grips of the institutional imperative. You have found the financial proof of their folly. The same institutional force that drives mindless M&A also creates a second, more insidious form of value destruction, a crippling resistance to change. An organization that has achieved great success with a particular business model becomes its own greatest enemy. The very culture, processes, and incentive structures that created its dominance become a cage, preventing it from adapting to a changing world. The institutional imperative in this context is the mandate to protect the status quo, to defend the existing cash cow at all costs, even when the world is signaling that the cow is sick and dying. This is the lethargy of the incumbent, a corporate disease that creates enormous opportunities for investors who can diagnose it early. Warren Buffett's long and complex relationship with the newspaper industry provides a perfect, multi-decade case study of this phenomenon. For much of the 20th century, a dominant local newspaper was one of the greatest businesses imaginable. It was a de facto monopoly on information and advertising in its city. It had pricing power, low capital requirements, and a deep, unassailable competitive moat. Buffett understood this better than anyone. In the early 1970s, he began investing heavily in the Washington Post Company. He saw a business with a powerful franchise run by a brilliant and shareholder-oriented CEO, Katharine Graham. For years, this was a spectacular investment. The Post and other newspapers Berkshire owned, like the Buffalo Evening News, gushed cash. The institutional imperative during this golden age actually worked in their favor. The imperative was to raise ad rates every year, print the paper, and count the money. It was a simple, repeatable, and fantastically profitable formula. But then, in the 1990s and early 2000s, a new technology began to emerge: the Internet. At first, it seemed like a toy. It was slow, clunky, and its user base was small. The executives in the newspaper boardrooms comfortable in their success, largely dismissed it. Their entire identity, their infrastructure, their expertise, it was all tied to printing presses, delivery trucks, and physical ink on paper. The institutional imperative dictated that they protect this existing model. Instead of embracing the internet as a new distribution channel, they saw it as a threat. They engaged in what can only be described as strategic denial. They made half-hearted attempts to put their papers online, but they were terrified of cannibalizing their own print advertising revenue, which was still immensely profitable. They put up paywalls, then took them down. They offered their content for free, hoping to sell online ads, but the rates for those ads were a tiny fraction of what they could command in print. The core problem was psychological. For a newspaper executive who had spent 30 years in the business, their mental model of the world was built on classified ads, display advertising, and subscription revenue. The internet didn't just threaten their profits, it threatened their identity. The institutional response was to double down on what they knew. They continued to invest in bigger printing presses. They focused on managing the slow, graceful decline of their print business, rather than aggressively investing in the chaotic, uncertain, but ultimately world-changing potential of the digital business. Buffett, watching from the sidelines as an owner, saw this with painful clarity. He wrote in his letters about the transition from a world where newspapers were the primary source of information to one where they were just one of many. He lamented the destruction of their monopoly power, while competitors like Craigslist single-handedly destroyed the classified ad business, the most profitable part of any newspaper. Most newspaper chains were too slow, too bureaucratic, and too culturally resistant to mount an effective response. They were prisoners of their own past success. The story of the Buffalo Evening News is particularly tragic. It was once a dominant, cash-gushing monopoly, but as the city of Buffalo's population declined and the internet rose, its fortunes reversed. The institutional habits remained, the high staffing levels, the expensive printing operations, but the economic reality had changed forever. The business went from being a gusher of cash to a consumer of it. Buffett was eventually forced to shut it down, a painful decision for a man who loves to buy and hold forever. This long, slow-motion collapse was a direct result of the institutional imperative to resist change. The management teams at these companies were not stupid. They were simply trapped in a system that was designed to perpetuate the past, not to invent the future. They couldn't bring themselves to sacrifice the short-term certainty of print profits for the long-term uncertainty of a digital transformation. For an investor, the lesson is profound. When you see a dominant company facing a major technological or cultural shift, you must assume that its default response will be to resist. The opportunity lies in identifying this resistance early. You can bet against the lethargic incumbent, or you can bet on the nimble, unencumbered attacker who is free to embrace the future. The decline of the newspaper industry was not an unforeseeable act of God. It was a predictable outcome of institutional psychology. The paralysis that gripped the newspaper industry in the face of the internet is a classic case study in the dark side of cognitive consistency. The psychological principles that underpin an incumbent's inability to adapt are some of the most powerful forces in behavioral science. They create a powerful gravitational pull toward the status quo, a pull that is nearly impossible for a large organization to escape. The primary culprit is the status quo bias. Humans by nature prefer for things to remain the same. Change is threatening and requires effort. For a corporation, the status quo is not just an abstract preference. It's a multi-billion-dollar investment. The company has spent decades building factories, training employees, establishing supply chains, and perfecting a business model. This entire apparatus is optimized for the world as it comes, not the world as it might become. Any significant change threatens this entire ecosystem. A newspaper company's assets are its printing presses. An internet company's assets are its servers and code. To pivot from one to the other is not a simple adjustment. It is an act of creative destruction, requiring the company to tear down the very things that once made it successful. The psychological cost of this is immense, and most will choose the comfort of a managed decline over the terror of a radical rebirth. This is reinforced by what is known as commitment and consistency bias. As we discussed in the context of the investor holding a losing stock, this bias also operates at an institutional level. A company has publicly, for years, declared that its strategy is the best. The CEO has given speeches about the power of their distribution network or the quality of their manufacturing. To suddenly reverse course and say we were wrong and we need to change everything is an admission of failure that very few leaders are capable of making. Their personal and professional identities are tied to the existing strategy. They are psychologically committed. Therefore, they will continue to pour good money after bad, investing in the old model long after it has become economically unviable, simply to remain consistent with their past decisions. Think of a company like Blockbuster Video. As the threat of Netflix's DVD by mail service, and later streaming, emerged, Blockbuster's response was not to pivot. It was to double down on its retail stores. They remodeled them, added candy and popcorn, and tried to make the in-store experience better. They were committed to the idea of being a physical retailer. Every fiber of their institutional being was screaming to protect the stores. The idea of intentionally shutting down their primary source of revenue to invest in a nascent, lower-margin online business was unthinkable. They were consistent, and it led them straight to bankruptcy. Another powerful force at work is the endowment effect. This is the tendency to overvalue something simply because you own it. For a company, the endowment is its core business. The managers who run the print division of a newspaper don't see it as a declining asset in a shifting landscape. They see it as stanse division, the source of their career, their expertise, and their pride. They will defend it with a ferocity that is completely disconnected from its objective economic prospects. They will argue for more resources, they will project optimistic but unrealistic growth forecasts, and they will lobby against any new internal venture that might threaten their domain. This creates an internal corporate battle where the forces of the past are far more powerful and entrenched than the fragile, underfunded forces of the future. The new digital media group is a small startup within the company, while the print division is a powerful, politically connected empire. In this fight for resources and attention, the past almost always wins, until the entire company collapses. Finally, there is the simple human fear of the unknown. The existing business model, even if it's in decline, is known and predictable. You can forecast its revenues and costs with some degree of certainty. A new, disruptive model is fraught with uncertainty. Will customers adopt it? What will the profit margins be? Who are the new competitors? For a middle manager in a large corporation, there is very little personal upside in championing a risky, innovative project that might fail. But there is enormous personal downside. If the project fails, it's a black mark on their career. If they simply keep their head down and manage their part of the existing, declining business, they can continue to collect a paycheck for years. The incentive structure of most large corporations rewards risk mitigation, not bold risk-taking. This creates a systemic, institutional cowardice. The collective effect of these biases, status quo, commitment, endowment, and fear, is to create an organization that is brilliant at optimizing its present, but incapable of creating its future. As an investor, your task is to identify this state of psychological paralysis. You are looking for companies that talk about innovation but continue to allocate all their capital to the legacy business. You are looking for industries where a new technology has emerged and the old guard is responding with denial and dismissal. This is where you will find the next Blockbuster, the next Kodak, the next Sears. And on the other side of that trade, you will find the next Netflix. Identifying a company trapped in institutional lethargy is one of the most profitable skills a contrarian investor can develop. It requires you to look beyond the quarterly earnings numbers and become an anthropologist of corporate culture. Here is a practical, step-by-step blueprint for spotting the telltale signs of a company that is resisting a necessary and disruptive change. Step 1. Analyze capital allocation. This is the most crucial step because where a company spends its money reveals its true priorities, regardless of what the CEO says in the annual report. You must dissect the statement of cash flows. Look at the line item for capital expenditures or CapEx. Is the company still pouring billions into maintaining or expanding its old assets? A newspaper company still buying new printing presses in the year 2005 would have been a glaring red flag. A traditional automaker spending 95% of its R&D budget on improving the internal combustion engine and only 5% on electric vehicles and battery technology is telling you where its heart truly lies. Compare the CapEx and R&D spending on the legacy business versus new growth initiatives. If the new initiatives are being starved of capital while the old business is being fed, you have found a company that is talking about the future but living in the past. Talk is cheap, capital allocation is truth. Step 2. Read the language of denial. You must become a close reader of shareholder letters, earnings call transcripts, and executive interviews. You are listening for specific linguistic patterns that signal resistance to change. Look for dismissive language about a new technology or competitor. When executives call a new trend a niche product or claim their customers aren't asking for that, it's often a sign of defensive denial. The taxi industry dismissed Uber as a high-end black car service. Blockbuster dismissed Netflix as a niche for film buffs. Another pattern is what one might call innovation theater. This is when a company makes a lot of noise about its new digital transformation office or its innovation lab, but these initiatives are kept separate from the core business and have no real power or budget. They are public relations efforts designed to signal to Wall Street that the company is modern, but they have no impact on the company's actual trajectory. Look for a focus on vanity metrics. A legacy company might boast about the number of likes on its Facebook page or the number of downloads of its mobile app, while conveniently ignoring the fact that these activities are generating no meaningful revenue. They are using trivial New World metrics to distract from the collapse of their Old World business model. Step 3. Examine the board and management. Who is running the company? Go to the company's investor relations website and read the biographies of the executive team and the board of directors. How long have they been with the company? How long have they been in the industry? If the entire leadership team consists of lifers who have spent their whole careers in the same slowly changing industry, the odds of them embracing a radical new direction are vanishingly small. Their worldview, their professional network, and their core competencies are all tied to the old way of doing things. You should look for the presence of outsiders on the board, particularly people with technology or direct-to-consumer backgrounds who can challenge the institutional groupthink. A board full of industry veterans is a board that is likely to keep driving the car by looking in the rearview mirror. Step 4. Map the incentive structure. This is advanced analysis, but it is incredibly powerful. You need to read the company's proxy statement, specifically the section on executive compensation. What metrics is the CEO being paid for? Is the bonus tied to metrics of the old business, like same-store sales growth for a retailer or print circulation for a publisher? Or is it tied to metrics of the new business, like the growth of e-commerce revenue or digital subscriber numbers? Incentives drive behavior. If a CEO's multi-million-dollar bonus depends on propping up the numbers of the legacy business for one more year, they will do everything in their power to achieve that, even if it means starving the future of the company to do so. A compensation plan that heavily rewards short-term profitability in the legacy division is a death sentence for long-term innovation. By applying this four-part blueprint, analyzing capital flow, language, leadership, and incentives, you can build a mosaic of evidence. You can move beyond a superficial understanding of the company and develop a deep, structural insight into its capacity for change. You will be able to distinguish between the companies that are truly adapting and those that are just going through the motions, a distinction that is the key to avoiding the great value traps of our time and identifying the next generation of dominant businesses. The path of the 99% is paved with the tombstones of fallen giants. The typical investor's relationship with incumbent companies is one of blind faith and misplaced nostalgia. A combination that proves lethal in the face of disruptive change. Their fatal mistake is to confuse a great history with a great future. Let's imagine an investor in the early 2000s considering an investment in Eastman Kodak. For their entire life, Kodak has been a synonym for photography. It was a true blue-chip stock, a member of the Dow Jones Industrial Average, a company that was a staple of any conservative long-term portfolio. It had a brand that was recognized and trusted in every corner of the globe. Our investor, following the path of the 99%, looks at this history. They remember Kodak moments from their childhood. They see the company's massive revenues and its global footprint. They think, this is a safe, stable company. It's not going anywhere. They are falling for a powerful narrative of permanence. Their first error is to mistake the company's past business moat for a current one. Kodak's moat was built on chemistry, the complex proprietary technology behind film manufacturing and developing. It was a fantastically profitable business model. But the rise of digital photography wasn't just a new product. It was a paradigm shift that made Kodak's entire chemical expertise obsolete overnight. The moat hadn't just been narrowed, it had been drained and filled with concrete. Our investor, however, doesn't see this. They see a big, familiar company and assume its old strengths will protect it. Next, our investor hears Kodak's management talk about their digital strategy. Kodak was, in fact, one of the early inventors of the digital camera. Management points to this as proof that they get digital. They launch their own line of digital cameras and printers. Our investor is reassured. See, they think, they're adapting. But they fail to do the deeper analysis required by our blueprint. They don't look at the capital allocation. They don't see that Kodak was still pouring money into its dying film business, trying to manage the decline, instead of investing aggressively enough to win in the hyper-competitive electronics business. They don't analyze the new business model. They fail to see that while film was a razor and blades model, sell the camera cheap and make a fortune on the film and printing, digital cameras were a one-time sale with razor-thin margins. Kodak was trying to compete in a game where its old competitive advantages were worthless. They were moving from a beautiful monopoly to a brutal knife fight. As the years go on and Kodak's stock price begins to slide, our investor falls into the next trap: value illusion. The stock looks cheap based on its historical price. It used to be $90 a share. Now it's $20. It's a bargain. They might even buy more, a behavior known as averaging down. They are anchoring on the past price, failing to realize that the underlying intrinsic value of the business is collapsing even faster than the stock price. They think they are buying $1 for 50 cents, when in reality they are buying a 50-cent piece that will be worth a dime tomorrow. They are confusing a cheap stock with a good value. Finally, when the writing is on the wall and the company is clearly heading for bankruptcy, our investor holds on out of pure hope or stubbornness. They are emotionally invested in the company's story and their own decision to buy it. They read articles about potential turnaround plans. They cling to any shred of good news. They cannot bring themselves to accept the painful truth. The world has changed, and this company has been left behind. They ride the stock all the way down to zero. This tragic journey is the fate of millions of investors who trust brands over business models, who listen to narratives over numbers, and who extrapolate the past into the future. They fail to understand that the very size and success that makes an incumbent look safe is often the source of its fatal weakness. The institutional imperative to protect that success makes it impossible for them to make the painful, necessary choices to survive, let alone thrive in a new era. The contrarian makes money by seeing this reality clearly. The 99% lose money by clinging to a nostalgic illusion. The slow, grinding decline of a lethargic incumbent is not an abstract story. It's a multi-year process of financial decay that is clearly visible if you know where to look. The institutional imperative to resist change manifests in a series of predictable patterns across the income statement, balance sheet, and statement of cash flows. A skilled analyst can spot these financial symptoms long before the company enters its terminal phase. The first and most obvious sign appears on the income statement: revenue stagnation followed by decline. A company that is failing to adapt to a new market reality will first see its growth rate slow. What was once a company growing at 10% a year is now growing at 2% and then 0. Soon, the top line begins to shrink. In the early stages, management will have a litany of excuses: a weak economy, a temporary competitive pressure, a one-off event. But the persistent inability to grow revenue is the primary symptom of the disease. At the same time, you will often see a compression of gross margins. The company's old products, which once commanded premium prices due to a strong competitive advantage, are now facing new, often cheaper, competition. To maintain market share, the company is forced to cut prices. This directly erodes the profitability of each sale. So not only is the company selling less, but it's making less money on everything it sells. This combination of falling revenue and shrinking margins is a powerful 1-2 punch to profitability. Next, turn your attention to the selling, general, and administrative expenses, or SG&A. In a healthy, growing company, SG&A should grow more slowly than revenue, creating what is known as operating leverage. But in a decaying incumbent, you often see the opposite. The company is saddled with a bloated corporate structure, a massive sales force trained to sell the old product, and expensive legacy headquarters, all artifacts of its former glory. As revenues decline, these fixed costs become an ever larger percentage of sales, crushing operating margins. The company is trapped by its own high-cost structure, a direct result of the institutional inability to make painful but necessary cuts. The balance sheet also tells a story of decay. You might see rising inventory levels. As demand for the old product wanes, unsold goods begin to pile up in warehouses. This ties up cash and often leads to future write-downs when the inventory has to be sold at a steep discount. You may also see the company taking on debt not to invest in future growth but simply to fund its day-to-day operations and continue paying its dividend, a sacred cow for many older blue-chip companies. Using debt to pay a dividend is one of the most desperate and dangerous acts of financial engineering, a clear signal that the underlying business is no longer generating enough cash to support itself. Finally, the statement of cash flows reveals the terminal stage of the disease. You will notice that capital expenditures remain stubbornly high. The company is spending huge amounts of cash just to maintain its old, inefficient assets. This is often called maintenance capex. They are running faster and faster just to stay in the same place. At the same time, cash flow from operations begins to dry up. The combination of falling profits and cash being tied up in inventory and accounts receivable means the business is no longer a cash gusher. When maintenance capex exceeds the cash generated from operations, the company has become a, quote, cash furnace, burning money just to exist. This is the point of no return. By systematically tracking these metrics over a 5 to 10-year period, revenue growth, gross margins, SG&A as a percentage of sales, inventory turns, debt levels, and the relationship between operating cash flow and capital expenditures, you can watch the story of institutional decay unfold in the numbers. You can see the financial consequences of resisting change with mathematical certainty. This analysis provides the objective evidence needed to make a rational, contrarian decision, while the rest of the market is still captivated by the ghost of the company's glorious past. We have explored how the institutional imperative manifests in reckless acquisitions and a stubborn resistance to change. Now we turn to a third, closely related pathology: the relentless, often irrational, pursuit of growth for growth's sake. In the psyche of the modern corporation, bigger is almost always seen as better. The imperative is to expand the empire, often with little regard for whether that expansion actually creates any value for the company's true owners, the shareholders. This is the empire-building complex, a force that drives CEOs to chase revenue targets and market share, even if it means entering into low-return businesses that dilute the company's overall profitability. Warren Buffett has built his entire enterprise, Berkshire Hathaway, as an antidote to this very problem. But to truly understand the destructive power of empire building, we must look at a story he often tells, a parable of a management team that represented the polar opposite of this approach. It's the story of Tom Murphy and Dan Burke at Capital Cities/ABC, It is one of Buffett's favorite case studies in brilliant, rational management. Capital Cities was a small, relatively obscure company that started with a single bankrupt UHF television station in Albany, New York. Over several decades, Tom Murphy, its CEO, transformed it into a media powerhouse. He did it not by chasing size, but by pursuing a relentless, almost fanatical focus on profitability and return on capital. Murphy was the antithesis of the empire-building CEO. He was famously frugal. He ran his sprawling media empire from a tiny Spartan headquarters in New York. There were no corporate jets, no lavish executive perks. The focus was entirely on the business. His operating philosophy was simple: give great managers near total autonomy, but hold them strictly accountable for their financial results. He demanded high profit margins and was ruthless about cutting unnecessary costs. While other media companies were building gleaming corporate campuses and adding layers of middle management, Murphy was running the leanest operation in the industry. The defining moment for Capital Cities, the one that cemented Murphy's legend, came in 1985. In a move that stunned Wall Street, Murphy announced that his relatively small company was acquiring the mighty ABC, one of the three major television networks. It was a minnow swallowing a whale. ABC was more than 4 times the size of Capital Cities. The acquisition price was a staggering $3.5 billion. To the outside world, this looked like the ultimate act of empire building. But it was the exact opposite. Murphy wasn't buying ABC for prestige or to put a bigger number on his business card. He saw a bloated, inefficient, and undermanaged asset that he could acquire and dramatically improve. ABC had a prestigious brand and powerful television stations, but it was run with the classic big company mentality. Its costs were out of control, its profit margins were mediocre, and it was drowning in bureaucracy. Buffett was so impressed with Murphy's plan and his track record that he became a key financier for the deal, investing over $500 million to help make it happen. It was one of the biggest investments he had ever made, a massive bet on a single management team. What happened next is a textbook lesson in how to dismantle the institutional imperative. Murphy and his partner Dan Burke descended upon ABC's lavish corporate culture like a conquering army of accountants. They immediately sold the company's corporate jet. They got rid of the executive dining rooms with their private chefs. They eliminated entire layers of vice presidents and middle managers who were adding no value. They questioned every expense, from limousine services for executives to bloated production budgets. The culture shock was immense. The old guard at ABC, accustomed to the perks and prestige of a major network, was horrified. But the financial results were staggering. Within a couple of years, Capital Cities/ABC had the highest profit margins in the entire media industry. Murphy had taken a huge, inefficient bureaucracy and transformed it into a lean, profitable, cash-generating machine. He hadn't just made the empire bigger, he had made it vastly more valuable on a per-share basis. The lesson that Buffett draws from this story is profound. Growth is only valuable when it is profitable growth. An increase in revenue that comes with a decrease in profit margins or a poor return on the capital invested is not growth, it is destruction. The institutional imperative, however, does not make this distinction. It rewards the CEO who doubles the size of the company, even if they have the profitability in the process. Tom Murphy was a rarity, a CEO who was genetically immune to this impulse. His entire focus was on the denominator, on the amount of capital employed, and his goal was to maximize the return on every single dollar. He would rather run a smaller, fantastically profitable company than a larger, mediocre one. This mindset is the ultimate defense against the allure of empire building. And for investors, finding a CEO with this Tom Murphy gene is like finding the holy grail of capital allocation. The empire-building CEO and the rational, value-focused CEO like Tom Murphy are driven by entirely different psychological scripts. The empire builder is playing out a drama of status, ego, and social comparison, while the rational allocator is engaged in a cold, logical process of maximizing long-term per-share value. Understanding the psychological divergence is key to telling them apart. The primary psychological force driving the empire builder is what is known as the agency problem. This is the fundamental conflict of interest between a company's management, the agents, and its shareholders, the principals. The shareholders want to maximize their return on investment. The managers, however, are driven by a mix of incentives, including salary, bonus, prestige, power, and job security. As we've discussed, growing the size of the company often serves the manager's interests more directly than growing its profitability. Running a Fortune 500 company carries more social status than running a smaller but more efficient company. This isn't necessarily malicious, it's just human nature. People are wired to seek status and influence within their social group, and for a CEO, the size of their company is a primary status marker. This is amplified by managerial hubris. A CEO who has achieved a position of great power often develops an exaggerated sense of their own abilities. This overconfidence leads them to believe that they can successfully manage an ever larger and more complex organization. They believe they can enter new markets and compete with established players, even if their company has no real competitive advantage in that area. This hubris leads to what Buffett calls diversification, diversifying into unrelated businesses that the management team doesn't understand. The result is a sprawling, unfocused conglomerate of mediocre businesses that is worth less than the sum of its parts. The institutional pressure to grow also creates a powerful confirmation bias. When a CEO becomes fixated on an expansion project, say opening a chain of stores in a new country, they will unconsciously seek out information that confirms the wisdom of this decision and ignore or downplay information that contradicts it. They will listen to the enthusiastic subordinate who has prepared a rosy forecast and dismiss the cautious controller who is warning about the risks. The organization learns what the leader wants to hear, and a self-reinforcing feedback loop of optimism is created. The decision to grow becomes a foregone conclusion, with the subsequent analysis being little more than a charade to justify the pre-existing ambition. In stark contrast, the rational allocator, like a Tom Murphy or a Warren Buffett, is operating from a completely different psychological standpoint. Their mindset is that of an owner, not a manager. Buffett constantly refers to his shareholders as his partners. This isn't just a turn of phrase, it's a deep psychological orientation. He views the money in Berkshire's treasury not as the company's money, but as his partner's money. This creates an intense sense of responsibility to deploy that capital with the utmost care, just as he would with his own. This owner's mindset leads to a focus on per-share metrics. The empire-building CEO brags about growth in total revenue or total earnings. The rational allocator is obsessed with growth in earnings, 2 per share, and intrinsic value 2 per share. They understand that if you double your earnings but triple your number of shares to do it, you have made every owner poorer. They would rather buy back their own stock, reducing the share count and making each remaining share more valuable, than pursue a flashy but low-return acquisition. This owner's mindset also creates a profound sense of humility, the opposite of managerial hubris. Buffett is famous for his concept of the circle of competence. He is acutely aware of what he doesn't know. He will not venture into businesses or industries that he cannot fully understand, no matter how exciting they seem. This discipline prevents the kind of diversification that plagues so many other companies. The rational allocator's greatest strength is their ability to do nothing. In a corporate world that celebrates action, the hardest and often most profitable decision is to sit patiently and wait for the truly great opportunity. The institutional imperative screams, "Do something." The rational allocator has the psychological fortitude to say, "No, we will wait." As an investor, your goal is to penetrate the corporate narrative and determine which psychological script the CEO is following. Are they an agent, focused on size and status? Or are they a principal, obsessed with per-share value? The answer to that question will tell you more about your future returns than any financial model. Discerning the empire builder from the rational value creator is one of the highest arts of investment analysis. It requires a specific set of tools and a mindset that is skeptical of grand pronouncements and focused on the cold, hard evidence of capital allocation. Here is a blueprint for evaluating a management team's true intentions. Step 1. Master the concept of owner earnings. Forget the net income that most companies report. It's an accounting fiction, easily manipulated by changes in depreciation schedules or other assumptions. Warren Buffett long ago introduced a more honest concept, owner earnings. The calculation is simple. Start with reported net income, add back non-cash charges like depreciation and amortization, and then subtract the average annual amount of capital expenditures the business needs to maintain its competitive position and unit volume, maintenance CapEx. This final number is the true cash profit of the business, the amount of cash that could, in theory, be handed over to the owners at the end of the year. Your first task is to calculate this number for the past 10 years for any company you analyze. A management team that consistently grows owner earnings on a per-share basis is a management team that is creating value. A team that grows reported net income but sees flat or declining owner earnings is likely playing accounting games while the underlying business stagnates. Step 2. Analyze the 4 paths of capital allocation. A CEO with $1 of owner earnings has 4 basic choices of what to do with it. First, they can reinvest it back into the core business for growth projects. Second, they can acquire other businesses. Third, they can pay it out to shareholders as a dividend. Fourth, they can use it to buy back the company's own stock. Your job is to judge the wisdom of their choices. If they choose to reinvest in the business, you must ask, what has been the historical return on that invested capital? If the company can reinvest at high rates of return, this is the best possible use of cash. If, however, they are pouring money into low-return projects just to show growth, they are destroying value. If they choose to make acquisitions, you must apply the M&A analysis blueprint we've already discussed. If they choose to pay a dividend, it can be a sign of a mature, disciplined company. But it can also be a sign that management has run out of good ideas for reinvestment. If they choose to buy back stock, you must ask, at what price are they buying? A CEO who buys back stock when it is clearly undervalued is a brilliant capital allocator, acting just as a smart investor would. A CEO who buys back stock at any price, often just to offset the dilution from executive stock options, is simply running on a treadmill. The best managers are flexible. They will do whatever makes the most sense with their owners' capital in a given year. The worst are programmatic, following a rigid policy, e.g., we always pay a dividend, regardless of the circumstances. Step 3. Read the proxy statement like a hawk. The proxy statement, which companies must file annually, contains the section on executive compensation. This is a treasure trove of information. Ignore the platitudes and look at the formula. How is the CEO's bonus calculated? Is it tied to fuzzy, non-financial metrics or adjusted earnings? Or is it tied to hard, difficult-to-manipulate numbers like growth in owner earnings per share or return on invested capital? Look for the use of stock options. A massive overhang of executive stock options can be a red flag. It incentivizes management to do anything to get the stock price up in the short term, even if it harms the long-term health of the business. It also massively dilutes the ownership stake of regular shareholders. A CEO who is paid like a manager will act like a manager. A CEO whose compensation is tightly aligned with the long-term experience of the shareholders is more likely to act like an owner. Step 4. Listen for the owner's language. Finally, after you've done the numerical work, read the last 10 years of the CEO's letters to shareholders. Are they clear, candid, and educational? Does the CEO openly admit mistakes? Or are they filled with jargon, excuses, and self-congratulation? A CEO like Buffett writes his letters to inform his partners. An empire-building CEO writes their letters to sell a story to Wall Street. Look for a focus on per-share metrics. Count how many times the CEO mentions revenue versus how many times they mention per-share intrinsic value. The language they choose reveals their true mental model of the business. This four-step process, calculating owner earnings, judging capital allocation choices, dissecting compensation, and analyzing language, provides a robust framework for unmasking the empire builder. It allows you to separate the managers who are skillfully growing the value of the enterprise from those who are simply, and often destructively, growing its size. The path of the 99% is one of naive admiration for size and growth. The average investor is easily seduced by the siren song of the empire builder, mistaking frenetic activity for progress and rising revenues for value creation. Their portfolio becomes a collection of large, well-known, but often mediocre businesses that are slowly destroying the capital entrusted to them. The first and most common mistake is chasing headlines. When a company announces a major expansion into a new market, like China, or a foray into a trendy new industry, like artificial intelligence, the media gets excited. The company's name is in the news. The stock price often gets a short-term pop. The 99% investor sees this activity and thinks, this company is dynamic. It's a growth story. They buy the stock without ever asking the hard questions. What is the company's actual competitive advantage in this new market? What are the likely returns on the massive investment required to enter it? Is this a disciplined strategic move, or is it a Me Too action driven by the fear of being left behind? They are buying the story, not the business. The second mistake is a fixation on the top line, revenue growth. In our growth-obsessed culture, a company that is increasing its sales is seen as a winner. The investor on the path of the 99% checks the quarterly revenue number, and if it's up, they are happy. They rarely look deeper. They don't check to see if profit margins are shrinking. They don't check to see if the share count is ballooning due to a recent acquisition. They don't calculate the return on the capital that was invested to generate that growth. They are like a store owner who celebrates the fact that he sold twice as many widgets this year, ignoring the fact that he had to spend 3 times as much on advertising to do it and had to cut his price in half, resulting in a massive loss. Revenue growth, in isolation, is a meaningless and often dangerous metric. The third mistake is what can be called management worship. Many investors develop a cult-like admiration for a charismatic, high-profile CEO. They listen to their interviews on television, they read glowing profiles of them in business magazines, and they come to believe that this leader can do no wrong. They outsource their own critical thinking to this celebrity CEO. If the CEO says an acquisition is a brilliant move, they believe it without question. If the CEO announces a 5-year plan to double the size of the company, they cheer it on as a sign of visionary leadership. This hero worship blinds them to the actual financial results. They are invested in a personality, not a business. When the CEO's grand plans inevitably fail to deliver the promised returns, these investors are the last to see it, holding on long after the rational, skeptical investor has sold. This collection of errors, chasing headlines, fixating on revenue, and worshiping celebrity CEOs, is a recipe for financial disappointment. It leads investors to overweight their portfolios with large, sluggish, bureaucratic companies that are good at getting bigger but terrible at getting better. They are participating unknowingly in the CEO's game of empire building, a game in which the shareholders are almost always the ultimate losers. They fail to understand the simple, brutal arithmetic that a rational allocator lives by. It is not the size of the ship that matters, but the speed at which it is compounding its owners' capital. The destructive financial impact of the empire-building complex can be traced directly through a company's financial statements. A management team focused on growth at any cost leaves a trail of numerical evidence that a careful analyst can follow. By focusing on the right metrics, you can clearly distinguish between healthy, value-creating growth and its malignant, value-destroying counterpart. The first place to look is at the long-term trend of the company's return on equity, ROE, or, even better, its return on invested capital, ROIC. As we've discussed, these ratios measure the company's profitability relative to the capital base it employs. A company engaged in empire building will often see these critical ratios decline over time. They are adding more and more capital to the business through acquisitions or massive internal projects, but the returns generated by this new capital are lower than the returns on their legacy business. Each dollar of new investment brings down the company's overall average profitability. You might see a company that historically earned a 20% return on capital start a major expansion, and 5 years later, its return on capital has fallen to 12%. The company is much bigger, but it has become a demonstrably worse business. This erosion of profitability is the hallmark of diversification. Next, you must analyze the company's sources of growth. This requires a deeper dive into the numbers. You need to separate organic growth from acquired growth. Organic growth comes from the company's core operations, selling more of its existing products or successfully launching new ones. Acquired growth comes from buying other companies. A company that can consistently generate strong organic growth is usually a healthy, innovative business. A company whose growth comes almost entirely from acquisitions is often a sign of a management team that has run out of ideas for its core business and is now just trying to buy growth. This is particularly dangerous because, as we know, most acquisitions fail to create value. A key part of your financial modeling should be to build a historical picture of the company's revenue, excluding the impact of major acquisitions, to understand the true health of the underlying enterprise. Another critical financial connection is the analysis of share count. Look at the company's shares outstanding on its balance sheet or income statement over a 10-year period. A management team that is truly focused on per-share value will often use excess cash to buy back its own stock, causing the number of shares outstanding to decrease over time. This makes each remaining share a more valuable piece of the business. An empire-building management team, in contrast, will often do the opposite. They will use their own stock as a currency to make acquisitions, or they will issue millions of new shares to fund executive stock options. As a result, the number of shares outstanding constantly creeps upward. This is a subtle but powerful form of dilution. Even if the company's total earnings are growing, the earnings tris may be stagnant or declining because the pie is being divided into more and more slices. Always track the per-share metrics, not the totals. Finally, look at the relationship between growth and free cash flow. A healthy company's growth should be self-funded. Its operations should generate more than enough cash to pay for its expansion projects. A company in the grip of the empire-building imperative often outspends its means. Its ambitious growth plans require more capital than the business generates. This results in negative free cash flow. To fund the gap, the company must consistently take on more debt or issue more stock. This is the definition of unsustainable growth. It's a company that is growing, but it's doing so by consuming capital rather than generating it. By combining these 4 analytical lenses, tracking ROIC, dissecting the source of growth, monitoring the share count, and analyzing free cash flow, you can build a powerful quantitative case against the empire builder. You can prove, with numbers, that their pursuit of size is coming at the direct expense of shareholder value. This financial rigor is your ultimate defense against the seductive but ultimately hollow narratives of growth for growth's sake. We now arrive at the 4th manifestation of the institutional imperative, a force perhaps more powerful than any other because it is rooted in our deepest social instincts, the tyranny of the peer group. Organizations, much like the individuals who comprise them, feel an intense pressure to conform. The fear of being different, of standing apart from the crowd, is a terrifying prospect for most CEOs and board members. If every other company in your industry is adopting a certain strategy, opening an office in a certain country, or investing in a certain technology, the pressure to follow suit can become irresistible, even if the move makes no logical sense for your particular company. This mindless imitation, this fear of being an outlier, leads to entire industries making the same mistakes in unison, creating massive bubbles and subsequent crashes. There is no greater example of this phenomenon, and Warren Buffett's courageous resistance to it, than the dot-com bubble of the late 1990s. To truly appreciate the story, you must transport yourself back to that era of irrational exuberance. The internet was new, exciting, and it promised to change everything. A new breed of company, the dot-com, was being born. These companies had no profits, often no revenue, and sometimes no finished product. But they had a business plan that involved the internet, and in the fever of the times, that was enough. Their stock prices soared to astronomical valuations. The market was enthralled. The institutional imperative was in full force. It was no longer acceptable for a CEO of any company, in any industry, to not have an, quote, internet strategy. A CEO of a staid industrial manufacturer would be grilled by analysts. How are you leveraging the power of the new paradigm? A retail company was expected to become an e-commerce giant overnight. The pressure was immense. To not participate was to be labeled a dinosaur, a relic of a bygone era. And in the midst of this mania, there was Warren Buffett. He was, at the time, the most successful investor in the world, a living icon. But he refused to play the game. He watched as technology stocks, many of which he had never heard of, doubled and tripled in price in a matter of weeks. He admitted, publicly and repeatedly, that he did not understand these new business models. He could not project their cash flows 10 years into the future, which was a core requirement of his investment process. Because he couldn't understand them, he wouldn't invest. For this, he was mercilessly mocked. Barron's, a leading financial magazine, ran a cover story in 1999 with the headline, "What's Wrong, Warren?" The article suggested that his value investing philosophy was dead, a relic of an industrial economy that no longer existed. He was seen as an old man who had lost his touch, unable to grasp the brilliant future that was unfolding. The pressure on him must have been unimaginable. Even his own shareholders were questioning him. At the Berkshire Hathaway annual meeting, people would ask him, year after year, why he was missing out on the greatest wealth creation engine of all time. His answer was always the same: "It is outside my circle of competence." The climax of this drama came in July 1999 at an exclusive conference in Sun Valley, Idaho, attended by the titans of media and technology. Buffett was asked to give a speech. The audience was filled with the very people who were getting rich off the bubble: tech CEOs, venture capitalists, and media moguls. Everyone expected him to either capitulate and admit he was changing his tune, or to deliver a defensive, out-of-touch speech. He did neither. Instead, he delivered a calm, logical, and devastatingly prophetic analysis. He walked the audience through the history of other great technological revolutions: the automobile, aviation, electricity. He showed how, in every single case, the initial speculative frenzy led to huge losses for investors. The industries grew and changed the world, but the vast majority of the early companies went bankrupt. He argued that while the internet would certainly change the world, it did not suspend the laws of business valuation. A great business still needed to generate profits. He calmly predicted that the aggregate returns for investors in this new crop of companies would be terrible. He was, in effect, telling a room full of internet billionaires that their fortunes were an illusion. The speech was met with polite but dismissive applause. People thought he was simply justifying his own poor performance. A few months later, in March of 2000, the bubble burst. The Nasdaq index, which had been the epicenter of the mania, began a catastrophic collapse, ultimately losing nearly 80% of its value. Hundreds of dot-com companies went bankrupt. Trillions of dollars of phantom wealth were vaporized. And Warren Buffett, the dinosaur, was revealed to be the prophet. His refusal to bow to the tyranny of the peer group, his willingness to look foolish and be left behind in the short term, had preserved his capital and his reputation. This story is the ultimate lesson in contrarian investing. It teaches us that the market is not always rational. It can be, and often is, swept up in collective delusions. The greatest opportunities, and the greatest protection against risk, come from the ability to stand apart from the crowd, to think for yourself, and to stick to a disciplined process, even when, especially when, the entire world is telling you that you are wrong. The institutional imperative to follow the herd is a path to mediocrity at best and to ruin at worst. The collective delusion of the dot-com bubble was not a random event. It was the predictable outcome of powerful psychological forces that drive conformity and suppress dissent. Understanding these forces is essential for developing the mental fortitude required to be a true contrarian. The tyranny of the peer group is built on a foundation of several key cognitive biases. The most fundamental is what we've already touched upon: social proof. When we are uncertain about what to do, we look to others for cues. In the late 90s, the stock market was entering uncharted territory. No one really knew how to value a company with no earnings. In this environment of high uncertainty, the actions of others became the primary source of information. An investor would see their neighbor getting rich buying tech stocks. They would see respected market commentators on TV praising these companies. The signal was overwhelming. This is what we are doing now. The correctness of the action was inferred from its popularity. This created an informational cascade, a phenomenon where people abandoned their own private information and judgment to follow the behavior of those who acted before them. Imagine the first few analysts who put a buy rating on a .com stock. The next analyst, seeing these ratings, might question their own more skeptical analysis. Maybe they know something I don't. It becomes easier and safer to just agree with the emerging consensus. Soon you have a cascade of buy ratings, none of which are based on independent fundamental analysis, but are simply reinforcing each other. At a corporate level, this is even more powerful. A CEO sees his top 3 competitors launch major e-commerce initiatives. His own private information, his company's lack of technical expertise, the high cost, the uncertain return, tells him it's a bad idea. But the actions of his peers create a new, powerful piece of information. To ignore it is to risk being the only one left out. A fascinating and insidious bias that contributes to this is pluralistic ignorance. This is a situation where a majority of group members privately reject a norm, but they go along with it because they incorrectly assume that most others accept it. In many boardrooms during the bubble, there were likely several directors who privately thought, "This internet strategy makes no sense and is a huge waste of money." But no one wanted to be the lone voice of dissent, the Luddite who doesn't get it. So they remained silent, and their silence was interpreted by the others as agreement. Everyone privately disagreed, but publicly conformed, creating an illusion of unanimous consensus that wasn't real. Finally, there is the authority bias. In the late 90s, a new class of authorities emerged. The venture capitalists who funded these companies, the hotshot young CEOs who graced the covers of magazines, and the market analysts who specialized in the new economy. Their pronouncements were treated as gospel. They created a new language and a new set of metrics, eyeballs, stickiness, burn rate, that were used to justify the unjustifiable. Because these new authorities seemed so confident and were, for a time, so successful, the majority of people suspended their own critical judgment and deferred to the experts. Warren Buffett's genius was his psychological immunity to these forces. His internal scorecard was more important than the external one. He did not derive his sense of validation from what others thought of him or from what was popular. His validation came from his own rational, independent analysis. He understood that the popularity of an idea has no bearing on its validity. He was willing to be the lone dissenter, to endure the social pain of being an outcast, because his conviction was based on a lifetime of disciplined thought, not on the fleeting opinions of the crowd. He actively fought against the authority bias by sticking to his own timeless metrics of value, not the fashionable new ones. To become a successful contrarian, you must cultivate this same psychological independence. You must learn to recognize the pull of social proof and consciously resist it. You must have the courage to speak up when you are the only one in the room who disagrees. You must in essence care more about being right in the long run than about being popular in the short run. It is a lonely and difficult path, but it is the only one that leads to superior, long-term results. Embracing a truly contrarian investment philosophy is not just about, quote, buying when there's blood in the streets. It's a systematic process of independent thought and rigorous analysis that insulates you from the emotional tides of the market. Here is a blueprint for building your own contrarian framework, allowing you to stand apart from the tyranny of the peer group. Step 1. Develop an inviolate set of first principles. You cannot be a successful contrarian without a core philosophy, a set of immutable rules that govern your actions. For Buffett, these principles include: only invest within your circle of competence, always demand a margin of safety, and view a stock as a piece of a business, not a blip on a screen. You must define your own. Will you only buy companies that generate free cash flow? Will you refuse to invest in companies with high levels of debt? Will you require a certain minimum return on invested capital? Write these rules down. They are your constitution. When the market becomes a howling mob, driven by fear or greed, you will not refer to the headlines for guidance. You will refer to your principles. This provides an anchor of rationality in a sea of emotion. Step 2. Invert. Always invert. This is a mental model Charlie Munger famously borrowed from the mathematician Carl Jacobi. Instead of asking, "How can I make money in this stock?" you should start by asking, "How can I lose money in this stock?" Think of all the ways an investment could go wrong. What could disrupt the business? How could the competition win? What if management makes a terrible decision? What if the economy enters a deep recession? This process, often called a pre-mortem, forces you to confront the risks up front. The typical investor engages in confirmation bias, looking for reasons why their idea is brilliant. The contrarian actively seeks out disconfirming evidence, looking for reasons why their idea is flawed. If, after rigorously trying to destroy your own thesis, it still holds up, you have something robust. Step 3. Value independently, then check the price. The 99% look at the price of a stock first. The price movement influences their opinion of the business. The contrarian does the opposite. They begin by analyzing the business in a vacuum, as if it were a private company they were considering buying in its entirety. They do a deep dive into its competitive advantages, its management, and its financial health. They build their own detailed financial model and come up with their own estimate of the company's intrinsic value, what it's truly worth. Only then they have a firm, independent opinion on the value of the business do they look at the stock price. This sequence is crucial. It prevents the market's opinion, the price, from contaminating your own analysis, the value. If your calculated value is significantly higher than the market price, you have found a potential investment. If the price is higher than your value, you move on, no matter how popular the stock is. Step 4. Cultivate patience and the courage to be wrong. True contrarianism is a long-term game. When you buy an out-of-favor asset, you are often early. The market may continue to disagree with you for months or even years. You must have the psychological fortitude to watch the stock go down after you buy it, to read negative headlines, and to feel foolish. This is the price of admission for contrarian success. Your conviction cannot be based on the stock's performance this week or this month. It must be based on the enduring validity of your initial analysis. This also means you will sometimes be wrong. No investor is right all the time. The key is to recognize a mistake, learn from it, and sell, rather than becoming emotionally committed to a losing position. A true contrarian is not stubborn. They are rational. They are loyal to their principles and their analysis, not to a particular stock. By building this systematic approach, grounded in principles, focused on risk, sequenced for independence, and sustained by patience, you forge the mental armor necessary to defy the herd. You stop being a reactor to the market's whims and become a proactive, independent thinker who uses the market's manic-depressive mood swings as a source of opportunity. The path of the 99% is the path of least resistance. It is the comfortable, socially validated path of following the crowd. In investing, this means buying what is popular, chasing what is hot, and believing in the prevailing narrative of the day. It is a strategy that feels safe and smart right up until the moment it leads to catastrophic losses. Let's revisit the dot-com era through the eyes of the typical investor. In 1999, their portfolio of safe, blue-chip stocks is underperforming the market badly. Their neighbor, a dentist who just started day trading, is bragging at a barbecue about the fortune he's made on a company called Pets.com. The investor feels a potent mix of envy and anxiety. They feel foolish for being so conservative. This is the first step onto the path of the 99%. the surrender of one's own judgment to social pressure and FOMO. The investor starts watching the financial news channels. The analysts are all talking about a new paradigm. They say traditional valuation metrics don't apply anymore. It's all about growth, eyeballs, and market share. The investor, who has always thought that profits mattered, begins to doubt their own sanity. They fall victim to authority bias, believing these confident-sounding experts must be right. They abandon the timeless principles of business analysis for the fashionable new jargon of the bubble. This is the second step, the abandonment of first principles. Finally, they capitulate. They sell their shares in a profitable, reasonably priced company like Coca-Cola and pour the money into a basket of popular tech stocks with names like eToys, GeoCities, and Webvan. They don't really understand what these companies do, and they certainly can't justify their valuations, but everyone else is doing it, so it must be the right move. For a brief moment, they feel brilliant, their new stocks go up, they have joined the party, they have successfully conformed to the peer group. This is the final, fatal step, the active participation in the mania. Then, the bubble bursts. The stocks they bought, which had no underlying value, collapse. Their portfolio is decimated. They panic and sell at the bottom, locking in their losses. They blame the market, they blame the analysts, they blame bad luck. But the real cause was their complete submission to the tyranny of the peer group. They committed the cardinal sins of the 99%. They chose popularity over profitability. They chose the narrative over the numbers. They chose short-term social comfort over long-term rational analysis. They were afraid to be different, and they paid the ultimate financial price for that fear. The great irony is that the contrarian path, which feels so risky and uncomfortable during the mania, is the only truly safe path in the long run. It is the path grounded in the reality of business value, a reality that can be ignored by the crowd for a time, but which always, eventually, reasserts itself with brutal force. The 99% are forever chasing the last bubble, arriving just in time for the pop because their decisions are driven by the actions of others. The contrarian is positioned to profit from the inevitable fallout because their decisions are driven by their own independent, disciplined thought. The financial consequences of herd behavior are as stark as they are predictable. A market bubble is a massive, temporary distortion of prices away from underlying value, and its signature can be found all over the financial landscape. A contrarian investor who knows what to look for can identify the quantitative signs of a mania and use them to avoid disaster. The most obvious signal is in valuation metrics. During a bubble, traditional metrics like the price-to-earnings (PE) ratio become stretched to absurd levels. A healthy historical average for the PE ratio of the overall market might be around 15. During the dot-com bubble, the PE ratio for the S&P 500 soared to over 30, and for the tech-heavy NASDAQ, it was well over 100. Many companies, of course, had no earnings, so investors invented new metrics to justify their existence. The most famous was the price-to-sales ratio. A mature, profitable company might trade at 1 or 2 times its annual sales. During the bubble, it was common to see dot-com companies trading at 50 or even 100 times their sales, which were often negligible to begin with. Another metric was price per eyeball, an attempt to value a company based on its website traffic. These fantastical metrics are a clear financial signal that the market has detached from reality and is operating on pure speculation. A contrarian simply refuses to play this game. They stick to valuations based on profits and cash flows, which forces them to stay on the sidelines during the mania. Another key financial connection is the quality of the companies coming to market. During a bubble, the standards for an initial public offering, or IPO, collapse. Investment banks, eager to cash in on the frenzy, will bring any company public, regardless of its quality. You see a flood of IPOs for companies that are young, unprofitable, and have no clear path to ever making money. The financial statements of these companies show massive losses and huge negative cash flows. They are not businesses. They are concepts, funded by shareholder cash that is being rapidly burned on marketing and promotion. A careful analysis of the IPO market can serve as a powerful sentiment indicator. When a large percentage of new companies coming to market have no earnings, it is a five-alarm fire, a clear sign that speculative excess has replaced sound business judgment. You can also see the bubble's effect on the balance sheets of established old economy companies. As we've discussed, these companies feel immense pressure to participate. They often use their cash and take on debt to acquire trendy, overvalued new economy businesses. This leads to a deterioration in the acquirer's balance sheet. You will see their goodwill balances explode and their debt levels rise. They are, in effect, trading their real tangible assets and earnings power for speculative, intangible assets with no earnings. This desperate attempt to appear relevant often permanently damages the financial health of the once stable business. By tracking these quantitative signals, the stretching of valuation multiples, the proliferation of nonsensical new paradigm metrics, the declining quality of IPOs, and the balance sheet deterioration of established firms, an investor can see the financial anatomy of a bubble. This is not about market timing, which is impossible. It is about risk assessment. When these signals are flashing red, the rational contrarian knows that the potential rewards of participating in the mania are dwarfed by the risks of a catastrophic collapse. They choose to sit patiently in cash or in undervalued, forgotten corners of the market, waiting for sanity to return. We have now reached the final, and perhaps most insidious, manifestation of the institutional imperative, the slow, creeping paralysis of bureaucratic bloat. As an organization grows in size and age, it naturally accumulates layers of management, complex processes, and rigid rules. This internal friction, this corporate sclerosis, can eventually become so severe that it chokes off the innovation, speed, and efficiency that made the company successful in the first place. The imperative shifts from serving the customer to serving the bureaucracy itself, a change that inevitably leads to a decline in competitive advantage and profitability. Warren Buffett's entire management philosophy at Berkshire Hathaway is a radical rebellion against this tendency. The story of Berkshire is not one of a single product or service, it is the story of a corporate structure designed with the express purpose of destroying bureaucracy before it can take root. The contrast between Berkshire's headquarters and that of a typical conglomerate is the most powerful illustration of this. The headquarters of a company like General Electric in its heyday was a sprawling, majestic campus populated by thousands of people. There were layers upon layers of management, strategic planners, corporate development teams, internal consultants, and an army of vice presidents. The central office exerted immense control over the operating businesses, demanding endless reports, budgets, and meetings. Now, consider the headquarters of Berkshire Hathaway, a company with a market capitalization in the hundreds of billions of dollars, controlling dozens of massive operating businesses like the BNSF Railroad, Geico Insurance, and Precision Castparts. Berkshire's world headquarters, the nerve center of this vast empire, occupies a single floor of an office building in Omaha, Nebraska. The total number of employees at headquarters? Fewer than 30. Not 30,000, but 30. There are no departments for strategic planning, no human resources, no public relations. Buffett and his small team practice a philosophy of extreme decentralization. When Berkshire acquires a company, its promise to the managers is simple. We will provide you with capital when you need it, and we will leave you alone. He trusts his managers completely to run their businesses as they see fit. He doesn't tell the CEO of See's Candies how to make chocolate, and he doesn't tell the CEO of Nebraska Furniture Mart how to sell sofas. His job is to do two things: to hire the right managers and to allocate the capital that their businesses generate. The story of his acquisition of Nebraska Furniture Mart in 1983 is a perfect example. The company was founded by a Russian immigrant named Rose Blumkin, known to everyone as, quote, Mrs. B. She was a legendary retailer who had built a massive, hugely profitable business from scratch. When Buffett went to buy the company, the deal was not negotiated by teams of lawyers and investment bankers. He sat down with Mrs. B, a woman who could barely read or write English, and asked her how much she wanted. She named a price. He thought for a moment and said, "Okay." The entire contract was a simple, 2-page document. He gave her a check for $55 million, and she gave him the company. And then, he did the most important thing. He left. He didn't send in a team of consultants from Omaha to synergize her operations. He didn't force her to adopt Berkshire's reporting systems. He let Mrs. B and her family continue to run the business exactly as they had before, because he recognized that their unique, entrepreneurial culture was the company's most valuable asset. The bureaucracy of a typical corporate acquirer would have destroyed that culture in a matter of months. Buffett's hands-off approach preserved it. This philosophy is the ultimate weapon against the institutional imperative. The imperative in a large organization is always to centralize, to standardize, and to control. This is driven by a desire to reduce risk and increase predictability. But in the process, it kills the very things that make a business great: speed, autonomy, and a sense of ownership. By keeping the headquarters small and the power in the hands of the operating managers, Buffett prevents the buildup of this value-destroying bureaucratic cholesterol. The lesson for an investor is to be deeply suspicious of large, centralized corporate structures. A company with a gleaming, oversized headquarters and a massive corporate staff is a company that is likely spending its owners' money on non-productive overhead. It is a company where decisions are probably made slowly, by committees, far from the actual customers. The lean, decentralized model of Berkshire is not just a quirky preference of its founder, it is a profound structural advantage that allows its businesses to remain agile and entrepreneurial, even as they operate under the umbrella of a corporate giant. The inexorable growth of bureaucracy in large organizations is not just a matter of poor management, it is a phenomenon with deep roots in organizational psychology and sociology. To understand why companies become bloated and slow, we must look at the psychological micro-traps that, when multiplied across thousands of employees, create institutional paralysis. One of the most famous principles is Parkinson's Law, articulated by Cyril Northcote Parkinson. In its most famous formulation, it states that, quote, "work expands so as to fill the time available for its completion." An extension of this is the observation that an organization's staff will inevitably grow, regardless of the amount of work that actually needs to be done. Parkinson's insight was that a manager who feels overworked will seek to hire subordinates, not rivals. These subordinates, in turn, create work for each other, generating reports, holding meetings, and requiring oversight. This creates the need for more managers, and the pyramid grows, with the amount of real productive output often remaining constant. The internal activity of the bureaucracy becomes an end in itself. Complementing this is the Peter Principle, which states that individuals in a hierarchy tend to be promoted to their level of incompetence. An employee who is good at their job gets promoted. They continue to get promoted until they land in a role that they are not equipped to handle, and there they remain, no longer effective. Over time, a large organization can become filled with managers who are incompetent in their current roles, and who then create more bureaucracy and process to mask their own shortcomings and justify their existence. At the level of individual decision-making, diffusion of responsibility takes a heavy toll. In a small entrepreneurial company, a single person is often responsible for a project's success or failure. The accountability is clear. In a large bureaucracy, decisions are made by committees. Dozens of people may have to sign off on a single, minor proposal. When responsibility is spread this thinly, no one feels a true sense of ownership. This leads to risk aversion. The personal career risk of approving a project that fails is far greater than the potential reward of championing a project that succeeds. The safest path for any individual manager is to say no, or to delay a decision by demanding more analysis or another meeting. The collective result of thousands of managers making this individually rational, self-protective choice is an organization that can no longer make a bold or timely decision. This is further compounded by what can be called complexity creep. As an organization grows, it naturally adds new rules, procedures, and reporting requirements. Each rule is often created in response to a specific problem and seems sensible in isolation. But over time, the accumulation of these rules creates a dense web of red tape that slows everything down. No one ever has the job of director of rule removal. The bureaucracy only grows. It never shrinks. The mindset of the people within the bureaucracy also shifts from an external focus on the customer to an internal focus on navigating the corporate structure. Success is no longer defined by creating a great product, but by getting a budget approved, winning a turf war with another department, or mastering the internal political game. The company's energy is turned inward, consumed by its own complexity, rather than outward, focused on the competitive marketplace. Buffett's decentralized model is a structural defense against all of these psychological traps. By keeping business units separate and autonomous, he ensures that accountability remains clear. The CEO of a Berkshire subsidiary cannot blame a slow decision on a committee at headquarters because there is no committee. By refusing to build a large corporate staff, he prevents Parkinson's law from taking root. And by empowering individual managers, he fosters a sense of ownership that is impossible to create in a top-down command-and-control system. As an investor, your task is to look for the signs of this psychological decay. You are searching for evidence of a culture that has become internally focused, risk-averse, and slow. A culture that is, in a word, bureaucratic. Identifying corporate sclerosis from the outside is a challenge. But by piecing together clues from financial statements, public documents, and even anecdotal evidence, an investor can develop a reasonably accurate diagnosis. This blueprint provides a checklist for spotting the telltale signs of a company that is being slowly strangled by its own bureaucracy. Step 1. Dissect the operating expenses. Your first stop is the income statement. You need to conduct a deep analysis of the company's selling, general, and administrative expenses, SG&A. Track this number as a percentage of revenue over a 10-year period. In a lean, efficient company, this percentage should be stable or declining as the company benefits from economies of scale. In a company suffering from bureaucratic bloat, you will often see the SG&A percentage creeping steadily upward. The company is hiring more managers, lawyers, and administrators at a faster rate than its sales are growing. This is a direct financial manifestation of Parkinson's law. You should also compare this ratio to the company's closest competitors. If your target company has an SG&A percentage of 30%, while its leanest competitor is at 20%, that 10-point difference represents a massive competitive disadvantage. A bureaucracy tax that is being paid directly out of shareholder profits. Step 2. Calculate revenue per employee. This is a simple but powerful metric for gauging organizational efficiency. Take the company's total annual revenue and divide it by its total number of employees. Then, compare this number to its primary competitors and track its trend over time. A company that is becoming more efficient and productive should see its revenue per employee increase. A company that is adding headcount without a corresponding increase in output will see this number stagnate or decline. A low and declining revenue per employee can be a strong indicator of a bloated, overstaffed organization where many people are engaged in low-value, internal-facing work. Step 3. Look for signs of restructuring. A company that is constantly restructuring is often a company that is battling a deep-seated bureaucracy problem. Read through the last 5 to 10 years of annual reports and press releases. Look for frequent announcements of synergy programs, cost-cutting initiatives, or organizational delayering. While these may sound positive, a constant need to restructure is a symptom of an organization that cannot control its own complexity. It's like a person who is constantly on a crash diet. It's a sign of a chronic underlying problem, not a healthy lifestyle. Pay close attention to the restructuring charges that these companies take. These are often buried in the footnotes, but they represent the real cash costs of severance packages, office closures, and consulting fees. A company that is constantly spending hundreds of millions of dollars to fix itself is a company that is fundamentally broken. Step 4. Read between the lines of employee reviews. This is a more qualitative but highly valuable source of information. Go to websites like Glassdoor, where current and former employees leave anonymous reviews of the company. You cannot take any single review as gospel, but by reading hundreds of them you can start to see patterns. Are employees consistently complaining about too many layers of management, slow decision-making, or internal politics? Do they describe a culture that is agile and entrepreneurial, or one that is bogged down in meetings and process? This is ground-level intelligence about the true operating culture of the company, the kind of information that will never appear in a glossy annual report. A pattern of negative reviews focused on bureaucracy is a massive red flag. By combining these 4 analytical techniques, a deep dive into SG&A, a calculation of revenue per employee, a history of restructuring charges, and a qualitative analysis of employee sentiment, you can build a compelling case that a company is suffering from advanced corporate sclerosis. You can identify the hidden tax of bureaucracy and understand how it is draining the company's competitive lifeblood. The path of the 99% leads to an implicit trust in size and complexity. The average investor is often impressed by a company with a massive global headquarters, a huge employee count, and a complex organizational chart. They mistake the appearance of power and sophistication for the reality of operational excellence. This is a fundamental and costly error. Let's consider an investor looking at 2 companies in the same industry. Company A has a modest headquarters, a lean management structure, and a reputation for being a tough, cost-conscious operator. Company B has a magnificent glass and steel corporate campus, a huge C-suite with dozens of senior and executive vice presidents, and is known for its generous perks and benefits. The investor on the path of the 99% is instinctually drawn to Company B. It looks more successful and prestigious. They equate the expensive headquarters with a powerful brand and the large management team with deep professional expertise. They are falling for the, quote, edifice complex, the belief that a company's physical presence is a reliable indicator of its financial health. They fail to ask the critical question, who is paying for that magnificent headquarters? The answer, of course, is the shareholders. Next, our investor reads the news about the 2 companies. Company A makes few grand announcements, instead focusing on incremental improvements to its core business. Company B, on the other hand, is constantly in the headlines with bold new initiatives, task forces, and strategic reviews, often run by expensive outside consulting firms. The investor is impressed by the activity at Company B. It seems dynamic and forward-thinking. They mistake motion for progress. They don't realize that much of this activity is just the sound and fury of a large bureaucracy justifying its own existence. The endless meetings and PowerPoint presentations at Company B are creating the illusion of work, while the focused, unglamorous execution at Company A is creating actual value. As time goes on, both companies face a challenge in the marketplace. Company A, with its lean structure, is able to make a decision and change course in a matter of weeks. At Company B, the decision must go through multiple layers of review, from the regional VP to the divisional SVP to the corporate strategy committee. By the time a decision is finally made, the market opportunity has passed. Our investor, however, doesn't see this internal paralysis. They only see the polished press releases and hear the confident pronouncements from the large management team. They hold on to their shares in Company B, believing that a company so large and with so many smart people must eventually get it right. They are committing the fatal error of believing that resources are the same as results. They fail to understand that in a complex and rapidly changing world, agility is a far more valuable asset than size. They end up owning a slow, lumbering battleship in an era that demands nimble destroyers. Their portfolio becomes a museum of once great companies that have become too big, too slow, and too complex to compete effectively. They have, in essence, chosen to invest in the bureaucracy itself, rather than in the productive enterprise it was supposed to serve. The financial cost of a bloated bureaucracy is a slow and steady drain on a company's economic vitality. It's not a sudden shock like a bad acquisition, but a chronic condition that erodes profitability and shareholder returns year after year. The evidence is written clearly in the financial statements for those who are willing to look. As we've noted, the most direct impact is on the company's operating margin. The bureaucracy tax of excessive corporate overhead, layers of middle management, and inefficient processes flows directly into the SG&A line. This means that for every dollar of sales, less is available to flow down to pre-tax profit. A company with a structural cost disadvantage will always struggle to compete with its leaner rivals. In a price war, the lean competitor can lower prices and still remain profitable, while the bloated company is forced to choose between losing market share or plunging into unprofitability. This lack of operational flexibility is a significant long-term risk. Another crucial financial connection is the impact on capital efficiency. A bloated bureaucracy not only increases operating expenses, but it also leads to a misallocation of capital. Decisions about where to invest are made by committees of people who are far removed from the front lines of the business. This often leads to safe, incremental investments in existing business lines rather than bold bets on new opportunities. It also leads to what can be called capital hoarding, where divisions within the company fight to protect their budgets and spend their allocated capital, whether the projects are value accretive or not, simply to ensure they get the same or a larger budget the following year. The result of this behavior is a declining return on invested capital. The company is spending more and more capital to generate the same or even less profit. The bureaucratic machine consumes capital with an alarming inefficiency. Furthermore, the slowness that bureaucracy creates has a direct impact on revenue. A company that takes 18 months to launch a new product when its more agile competitor takes 6 will consistently lose market share. A company whose sales process is bogged down in red tape will lose customers to competitors who are easier to do business with. This loss of competitiveness may not be immediately obvious in any single quarter, but over a period of years it will manifest as a slowing growth rate and a declining share of the market. The financial modeler must look for this gradual erosion of the company's competitive position. Finally, the constant need for restructuring in a bloated organization creates a steady drip of one-time charges that are anything but. These charges, which management will tell you to ignore as non-recurring, are a very real cost to shareholders. They represent cash spent on consultants, severance, and other cleanup efforts that could have been used for productive investment or returned to shareholders. A company that has a one-time restructuring charge every 2 or 3 years is really just admitting that it has a permanent, recurring problem with its own cost structure. By quantifying these 4 areas, the impact on operating margins, the decline in capital efficiency, the erosion of revenue growth, and the recurrence of restructuring charges, you can paint a detailed financial picture of the cost of bureaucracy. You can turn the abstract concept of corporate sclerosis into a concrete, quantifiable drag on the intrinsic value of the business. This analysis allows you to see the company not as the market sees it, but as it truly is, a productive enterprise trapped within the suffocating embrace of its own complexity. You have just spent this time acquiring a powerful and dangerous piece of knowledge. You have been given a new lens through which to view the entire corporate world. You now understand that beneath the surface of press releases and stock charts lies a hidden world of human psychology, a world of cognitive bias and institutional folly. You have learned to see the institutional imperative not as a vague concept, but as a predictable, exploitable force that drives companies to make catastrophic errors in acquisitions, to resist vital change, to chase size over value, to follow the herd off a cliff, and to choke on their own complexity. This is more than just an investment theory. It is a fundamental mental model for understanding how large organizations truly behave. You are now equipped to look at a blockbuster merger and see not a bold strategy, but a desperate act of FOMO. You can look at a declining blue-chip stock and see not a bargain, but a tragic victim of its own resistance to the future. You have the blueprint to separate the true value creators from the ego-driven empire builders. This knowledge gives you a profound and permanent advantage over the 99% of market participants who still believe the myth of corporate rationality. But what you have just mastered, as powerful as it is only one pillar in a much larger architecture of thought. Buffett's system for analyzing the world is not a collection of isolated tricks. It is a complex, interconnected web of mental models, a latticework, as his partner Charlie Munger calls it. Understanding the institutional imperative allows you to identify a flawed company. But how do you identify a truly great one? How do you quantify the strength of a company's business moat? How do you determine the precise margin of safety required for a given investment? These are not separate questions. They are the next links in the chain of reasoning. The framework you've just built is the diagnostic tool for identifying corporate sickness. The video that is now appearing on your screen is the other half of the equation. It is the blueprint for identifying enduring corporate health. It is the piece of the map that connects the predictable patterns of failure you have just learned to the predictable patterns of success that create generational wealth. It takes the foundation we have built today and elevates it, showing you how to move from simply avoiding losers to systematically identifying the world's most dominant and durable businesses. The choice to click is not about watching another video. It is a conscious decision to continue your ascent. It is a declaration that you are not a passive consumer of financial entertainment, but a serious architect of your own financial future. You have laid the first critical piece of the foundation. The next piece of the mental arsenal is waiting. Complete the structure.